Reaching $200,000 in net worth feels like a major financial milestone. For many people, it represents years of disciplined saving, career progress, and smart decisions. But strangely enough, this point in the wealth journey can also be one of the most fragile. Not because $200,000 is small, but because psychologically it often feels bigger than it really is. At this stage, many people begin to believe they've figured money out. They feel financially stable. They feel comfortable loosening discipline. And sometimes they begin making decisions that quietly slow or even reverse long-term progress. Financial planners sometimes refer to this as a behavioral inflection point, the moment when early success starts to create overconfidence, lifestyle expansion, and subtle risk shifts. And ironically, these shifts tend to appear right when compounding is finally starting to work. Today we're going to break down why the $200,000 milestone can quietly become a financial danger zone. Not because of market crashes, not because of economic crises, but because of human behavior. And once you see the patterns, it becomes much easier to avoid them. 1. The illusion of financial security. $200,000 creates a powerful psychological signal. It feels like a large number, and in many ways it is. But financially speaking, it's still an early-stage milestone. If that $200,000 were invested and compounded at a 7% annual return, it would grow to about $386,000 after 10 years without any additional contributions. That's meaningful progress, but it's not yet the type of capital that produces significant passive income. In fact, using the widely referenced 4% rule, a $200,000 portfolio could sustainably generate about $8,000 per year in retirement income. That's helpful, but it's clearly not financial independence. Yet, psychologically, the brain often interprets the milestone differently. Researchers at the University of Chicago Booth School of Business found that how people perceive wealth milestones dramatically changes behavior. Crossing a milestone like $100,000 or $200,000 often creates a mental sense of arrival, even though financially the journey is still in its early stages. And that perception shift can subtly change decision-making. 2. Lifestyle inflation quietly accelerates. At lower savings levels, spending discipline tends to feel necessary. When your net worth is $10,000 or $20,000, most purchases still require careful thought. But once your accounts cross $200,000, spending can begin to feel less restrictive. You might upgrade a car earlier than planned. You might choose a slightly larger home. You might subscribe to more services, travel more frequently, or justify lifestyle improvements that previously felt unnecessary. None of these decisions are inherently wrong. The problem is accumulation of small upgrades. Imagine someone who increases their lifestyle spending by $800 per month after reaching this milestone. That's $9,600 per year. If that same money were invested with a 7% return, it could grow to roughly $190,000 over 20 years. In other words, small lifestyle expansions during your peak saving years can erase large amounts of future compounding. A long-term behavioral study from Stanford University observed that as income and wealth rise, spending tends to rise almost proportionally. Researchers found that about 60% of income increases are absorbed by lifestyle upgrades within 2 years, and the same pattern often appears after wealth milestones. 3. Overconfidence begins to appear. Early financial success can also create a subtle trap of overconfidence. When someone builds a $200,000 portfolio through saving and investing, it's natural to feel proud. But that success can sometimes lead people to believe they have stronger investing skills than they actually have. This is where behavior begins to shift. Instead of steady investing, people start experimenting. They trade more frequently. They concentrate investments into a few positions. They start chasing trends. Cryptocurrency cycles, speculative tech stocks, and concentrated bets often attract investors right after early portfolio growth. Behavioral economists call this the house money effect. When people feel they're playing with profits rather than earned money, they take more risks. A famous study by Barber and Odine at the University of California at Berkeley analyzed tens of thousands of brokerage accounts. They found that investors who traded the most frequently earned significantly lower returns than those who traded rarely. Overconfidence did not increase performance, it reduced it, and the danger tends to emerge right after early success. 4. The compounding curve is just beginning. Here's something many people underestimate. The real power of compounding usually appears after the first few $100,000, not before. Imagine two investors. Both eventually reach $200,000, but what they do next is very different. Investor A continues contributing $15,000 per year and leaves investments untouched. Investor B slows contributions and increases spending because the milestone feels significant. After 20 years at a 7% return, Investor A could reach roughly $1.3 million. Investor B might end closer to $700,000 or $800,000. Both made it to the same milestone, but their decisions immediately afterwards created dramatically different outcomes. This is why financial planners often say the first $200,000 is the foundation. The next few $100,000 are where compounding starts to accelerate. 5. Risk perception quietly changes. Another subtle shift appears around this milestone. Risk begins to feel more real. When your portfolio is $10,000, a market drop of $1,000 feels manageable. But when your portfolio reaches $200,000, a 20% market correction suddenly represents $40,000. That's psychologically different. For some people, this leads to increased caution. They reduce stock exposure. They move money to cash. They delay investing during volatile periods. Ironically, these reactions often occur right before the years when compounding matters most. A well-known study from Dalbar, which tracks investor behavior, has consistently shown that the average investor significantly underperforms the market. One major reason is timing decisions driven by fear and recent market volatility. When portfolios grow large enough to feel emotionally significant, people often begin reacting instead of staying consistent. 6. Hidden financial leaks become larger. At smaller wealth levels, inefficiencies are relatively small. A $200 annual subscription barely registers. A slightly higher credit card interest rate might cost a few $100s. But as finances grow, small leaks scale with them. Consider investment fees. A 1% advisory fee on a $20,000 account costs $200 per year. On a $200,000 portfolio, that same percentage costs $2,000 annually. Over 25 years, assuming market growth, that difference can exceed $100,000 in lost portfolio value. And fees are just one example. Insurance inefficiencies, tax inefficiencies, unoptimized retirement accounts. These structural leaks become much more meaningful as balances increase, which means the 200K milestone is often the moment when financial structure begins to matter more than simple saving discipline. 7. The psychological plateau effect. There's another behavioral pattern that appears around this milestone. Progress can begin to feel slower. Going from $0 to $100,000 feels dramatic. Going from $100,000 to $200,000 also feels significant. But once someone reaches $200,000, the next milestone often takes longer. Markets fluctuate, life expenses increase, progress becomes less linear. And psychologically, this can create frustration. Some people respond by reducing saving effort. Others start searching for shortcuts, higher risk investments, aggressive speculation, unproven strategies promising faster wealth. Ironically, these attempts to accelerate progress often create setbacks rather than breakthroughs. Long-term wealth building tends to reward consistency more than intensity. But during plateaus, consistency can feel unsatisfying, and that's when people deviate from the process. 8. The real opportunity hidden at 200K. Despite the risks we've discussed, reaching $200,000 is still an excellent position. In fact, it's one of the most powerful launch points in the entire wealth journey, because at this stage, three important conditions often exist simultaneously. First, income is usually higher than in earlier career years. Second, financial knowledge has improved through experience. And third, the portfolio is finally large enough for compounding to begin accelerating. This combination creates a unique window. Small improvements during this stage can create disproportionately large long-term effects, increasing contributions by a few $1,000s per year, reducing unnecessary fees, maintaining consistent investment discipline during volatile markets, avoiding lifestyle inflation. These decisions may feel modest in the moment, but over decades, they dramatically shape financial outcomes. Conclusion: the 800K milestone that tests discipline. $200,000 is an important milestone, but it's not the finish line. In many ways, it's the point where the real financial journey begins, because at this stage, it introduces a series of subtle behavioral shifts: the illusion of security, lifestyle expansion, overconfidence, changing perceptions of risk, structural inefficiencies, and psychological plateaus. None of these are dramatic financial mistakes. They're quiet behavioral patterns, and that's exactly why they matter. The good news is that awareness changes outcomes. When people recognize these patterns early, they tend to make calmer, more consistent decisions. They protect the discipline that built the first 200K, and they allow compounding to continue doing its work. Because in the long run, wealth rarely comes from dramatic breakthroughs. It usually comes from steady decisions repeated over many years. And if the first 200K represents the foundation, the next few 100K are where the structure truly begins to rise. If you found this breakdown useful, make sure to subscribe for more clear, research-backed insights on money and long-term wealth building. And if you're interested in how wealth actually grows after the early milestones, you might want to watch the next video where we break down the stages most people experience on the path to financial independence.